Okay, so we're here with Helmut Pastrick, Chief Economist at Central One Credit Union, and of course, past guest. Thanks for coming back.
Oh, my pleasure.
Yeah, thanks so much for taking the time. We should say fan favorite as well.
Yeah, absolutely. Helmut, can you start maybe by telling our listeners a little bit about yourself?
Yes, well, I'm the chief economist for Central One Credit Union, which is provides services to all credit unions in BC and since 2008 credit unions in Ontario. So we monitor the economy and housing markets for our member credit unions.
Right. Is and a lot of local data, right? Like one of the things that I feel like you and your team put out for BC specifically that everyone in the real estate market gloms onto is kind of really digging down into the BC specific data.
Yes, that's right. Given the nature of our membership, credit unions are relatively small financial institutions, locally based, and so we need to drill down into regional and local market areas, their economic conditions, housing market activity, and forecasts as well. Yeah.
So we had you on, I guess it was a while back now.
Right.
We've talked to a few other economists more recently that were fairly bullish on 2020 earlier in the year. The real estate market, the economy in general. Obviously with COVID-19 or coronavirus, things have seemed to be changing by the hour. In fact, on the way over, I think it was just the World Health Organization just came out and said it's a pandemic, literally as I was driving over here. So I guess maybe we can start by on the economy side. Should we be afraid?
Well, I wouldn't say afraid. Concerned is probably a better way to describe it. And certainly the events of the past 2 or 3 months with the COVID outbreak has resulted in downgrade in our economic expectations for 2020. Clearly, the travel industry, the tourist industry are being negatively affected by the outbreak, and globally as well as nationally, provincially, and locally. Vancouver does have a considerable cruise ship industry, and the spin-offs from that will play out. So, and then, of course, the whole notion that people are simply hunkering down, if you will, less likely to attend events where there are large numbers of people. There have been conference cancellations, event cancellations. I'm not aware of any events in the Vancouver area, but certainly they have occurred elsewhere. And of course, the BC and Vancouver area economies are fairly small and very dependent on what happens outside those economies. What happens to the U.S. economy, to the Asian economies, all makes a difference as well. So yes, we've downgraded our forecasts for the BC economy and for 2020, and particularly for parts of the province that are more commodity-based, the northern BC, the Kootenay. China is the second largest economy in the world, but it is the largest consumer of commodities, oil, metals, and the like. So their slowdown is quite considerable, for at least for the time being, and we will that'll have a knock-on effects on those regional economies. For the Vancouver area economy, obviously it's more service-based, but again, it is the major transportation hub as well, and of course, in addition, we've had those rail blockades as well,
right?
And that has had some negative consequences. The backup in the ports, for example.
Right.
We've downgraded our forecast. We still see growth, but it's not as robust as what we thought. We're knocking it back by upwards of 0.5 percentage point thereabouts. But on the other hand, interest rates have come down.
Right.
So the housing market outlook generally has improved.
Mm-hmm. Well, we had a friend of ours mention the other day that it seems like Vancouver, the real estate market at least, is ignoring the COVID-19 for the time being. And then we were speaking to someone else who said that even though the interest rates are dropping, that's usually a clear indication that there's concern about the economy and that might actually counteract some of the housing market.
Yeah, true. It certainly could in the short term, but bear in mind the housing market was picking up before COVID-19. So sales began to pick up roughly second quarter of 2019 and began to gain momentum throughout the year. Prices soon followed. Roughly in the third quarter, we could see the inflection point in prices in the Lower Mainland, and prices have continued to rise.
Right.
The latest data, we have sales activity through to February, and February was a pretty good month. January was with the weather conditions were worse than normal, so it was a bit weak in January. But February numbers came back somewhat, and I fully expect that we'll see further sales gains in March and beyond. So the emergency rate cut that the Bank of Canada engineered just a week ago, 50 basis points, that cut, of course, reduces the prime lending rate. So variable rate mortgages have dropped by that amount, and fixed rate mortgages are now coming down as well.
Right.
Yeah, and also we have the change in the stress test effective April 6th of this year, where for insured mortgages, the benchmark rate will now be based on a more market rate, and rather than the Bank of Canada's posted 5-year fixed rate. And posted rates move very slowly and not really in tandem with market rates. And so this shift to a more market-based benchmark rate will result in a lower rate. And that, in turn, will improve, the accessibility to mortgage financing, and hence, I think, at the margin, more housing sales.
I was just thinking, like we've suffered from really low inventory for a long time now in the market, and I mean we've been around 20% down on inventory, and it seems like a lot of good product is not coming to market. That's kind of been the challenge. I'm just wondering if COVID-19 kind of shakes some inventory loose potentially for the spring market, which
or the opposite though.
Well, my thought was that if somebody was thinking about selling this spring or summer, and the market's still really good right now, the fear of the market shifting might force them onto the market earlier. What was the alternative?
Or the alternative, I guess, is that everybody's hunkering down. It's not the time to make a move. Right?
Sure.
Yeah. Well, that's right. Now, typically, under normal conditions, sales pick up during the spring, and so do listings. So the supply of units on the market tends to pick up in tandem with housing sales and housing price activity. But it's true that the number of listings on the market has declined ever since that sales pickup occurred roughly mid last year,
right,
and remains low. So yes, we do need more supply on the market. Market conditions are tightening. Price pressures are certainly well entrenched, and we are now in another upswing on housing prices. And this is in the Lower Mainland, and even in this single detached market, which was the hardest hit. Going back to the foreign buyers tax of 2016 and et cetera. That market, too, is beginning to stabilize and I would predict show price gains.
Actually, it seems prices
Vancouver,
are increasing.
Prices are increasing.
Yeah,
and the west side,
dramatically, actually.
And the west side houses now, I mean, seem to really, I mean, there was the house that had 46 offers on it, I think, last week. I mean,
it was underpriced.
It was underpriced and entry level, but still sold for probably $200,000 more than where it would have sold 3 months ago, right?
Yeah.
So we're seeing some upward pressure on pricing in the detached
and in other
side.
parts of BC, we never really saw much of a price decline. In fact, in the Victoria market, the Vancouver Island market, prices more or less slowed. The rate of increase slowed and never really declined. Unlike in Vancouver, which is really driven by the single family market decline. Condo prices have held up quite nicely. In fact, condo condo prices continue to rise in the Lower Mainland, albeit at a slower pace, but now are picking up, and they're at record highs. And the same would apply to the Kelowna market, most of the island market. We do have weak spots in BC, clearly with the forest lumber problems we see in the central, in the Caribou region, in the northeast with the oil or the gas situation. So there are weak markets within the BC, but of course, the Lower Mainland, Vancouver Island, and Kelowna, they dominate the numbers.
Right. Do you see COVID-19, because a lot of what you're saying sounds pretty positive here for Vancouver. Do you see COVID-19 as the biggest threat to the real estate market and also the larger economy in 2020? And I'd love to hear your thoughts on how governments around the world are kind of approaching it.
Yeah, I think for the time being, COVID-19 probably is the largest threat through the economy, global economy, national and local. Of course, we now have this oil price war that just erupted over the weekend,
Right.
and that has quite negative consequences, obviously, for our friends in Alberta,
Right.
Saskatchewan, Newfoundland, and the like. So that's another hit to the economy, to markets as well, and sentiment. So we'll see how that plays out, whether there's some agreement between Russia and Saudi Arabia that might come out in the coming weeks. But right now, it's COVID-19 is the largest concern for the economy. But that too should be temporary. 2021 should be we should see better economic conditions. This is a temporary outbreak. Ultimately, I think will be contained. It may take more weeks, or hopefully not too many more months, and then more normal activity will resume. The supply chain disruptions that have occurred in China, look to be ending, and there's some anecdotal evidence that some businesses are beginning to start up again in China, although it's still very early. So certainly for the first quarter of this year, the second quarter of this year, the economic numbers, which have yet to come out and reflect the supply chain disruptions, COVID-19 impacts, will be coming out in the month. So industrial production, retail sales numbers, all of those other main economic indicators have yet to reflect that negative impact, those negative impacts, and that'll be coming out in the coming months, really. So I'm looking, most forecasters are expecting the second half of this year to begin to see stabilization and some resumption of growth. And quite frankly, there could be some, the first, when we begin to see that, there could be a pretty good rebound in economic growth to make up for this lost activity,
Right.
particularly on the manufacturing side. The lack of the drawdown on inventories will need to be dealt with as well. So there'll be some makeup activity. Now, some will be lost. There'll be some outright economic losses. The event cancellations and the like will not be made up. But we should see some better economic conditions develop later this year, hopefully, and very likely by 2021. Yeah. So I was just going to say, the emergency rate cuts that played out is a signal that, the policymakers are taking this very seriously. Led by the Fed's 0.5 point percentage cut a week or so ago. In fact, the Fed meets again next week, and very likely we see another 0.5 percentage point cut in their policy rate. And the Bank of Canada cut 50 basis points or 0.5 percentage point. The next meeting for the Bank of Canada is mid-April. And I would expect another 50% or 50 basis point cut.
That's incredible.
Yeah, and so the prime rate will be, again, consequently that much lower. Bond yields have come down in the marketplace to very low levels, and therefore the cost of funds for lenders to fund mortgages is also beginning to come down, and that should reflect lower mortgage rates should be the result.
So clearly you're not seeing this because, Monday, we're kind of casual observers of the stock market, I would say at best. But obviously we saw the biggest declines on the stock market Monday since the crisis of 2008. You're not seeing this, it's by what I can understand, you're not seeing the kind of confluence of the coronavirus with the oil issues and the blockade, I guess, in Canada as leading to a crisis like we saw 10, 12 years ago.
No, correct. No, it's not like the great financial crisis of 08, 09, where it really was a credit event. A real credit crunch developed for a variety of reasons. This time, credit is being supplied to the market. It's really it's a demand shock, COVID-19. So people just withdrawing from the economy, if you will. And of course, there's supply chain disruption. So that's a supply shock. The oil price is a supply shock on the other side, increasing oil production and reducing prices. So, but more importantly, it's temporary. The COVID-19, and we had SARS. We had the Asian flu, H1N1 play out. And probably others over the history, and we get through this. There will be ultimately a vaccine developed, albeit a year or more, and again, activity will resume. So I'm not. This is not like the great financial crisis of 2008, 2009. Even though we've seen these very large reactions on financial markets, the equity market, the bond market. So in that sense, it kind of looks like what it was back in, but
feels like
those financial markets, they react very quickly and often overreact both on the upside and the downside. And there's a lot of algorithmic trading that's going on. Just there's no one really pressing the button saying I want to buy or sell this stock. Right. It's just computerized trading. This has been around for quite a while, but it tends to accentuate the upswings and the downswings. So, there are many analysts who say, well, the stock market was overvalued prior to this. Valuations were high, PE ratios, et cetera, all those technical indicators. So some sort of, substantial downdraft as these negative events developed is understandable. And so it's kind of a normal market correction, if you will. It could potentially be a bear market, i.e. a 20% decline from peak to trough. We're very close to that, by the way. But we've gone through this before, and quite frankly, for those who have the right time frame and the right approach, it probably is a buying opportunity. When you think about it, Warren Buffett's famous phrase is, when the greedy, are out there, that you should be fearful. But when there's a lot of fear out there, be greedy. So do the opposite, if you will.
You know what? And it's so funny because I was talking to somebody and I remember thinking about for years after the 2008, 2009, especially looking at Canadian bank stock when it dropped it was talk about being on sale, right?
Yes.
And then you look at what's happened in the last week, and I was saying to somebody I know who does kind of sits behind the computer. They're like, I'm a little shell shocked. I don't think I'm going to get involved. But it may be actually the time.
It is.
It's like, this is not the time to be shell shocked and watch the opportunity go
That's
by.
right. And this is where we put emotion aside, both on the fear and on the, being too aggressive. And quite frankly, most of us, including myself, basically ride it out.
Yeah.
Don't make any, and that's often usually the correct position to be in. If you do have some cash you could deploy, or you want to rebalance your portfolio, then this is a good time to do that as well. But for the most of us, we ride it out. We don't have the time or expertise to really make wise decisions. And most of us, when we enter the market, we're just kind of retail investors, and we do go on emotion. And unlike professionals who are guided by more rational behavior, if you will, and thinking.
Right. I think there's always the fear of throwing good money after bad, right?
Yes, yeah.
I just had a question, just staying on the stock market, because we're out, at open houses, pounding the pavement, and people over the last week have asked on more than one occasion, okay, look at what's happening in the stock market. How does that impact real estate here in Vancouver? Can you talk a little bit about if there's any relationship as far as you see in terms of stock market and real estate?
Well, the sort of economic relationship is typically, stock market wealth, to the extent that it declines or increases, can have some some economic impact. So it can affect spending, if you will. Their estimations have been that for every $100 increase in wealth, whether it's through equities or housing, it may impact spending on the order of $3 to $5. That kind of relationship. So that's probably the best economists can do. However, on the sentiment side, which is difficult, the psychology, the fact that we see these substantial movements on financial markets, and what the heck is going on, and when will it end, and where will it end? That could delay some, could have an effect on the real economy and the housing market. Say, well, I'm just going to hold off. I'm going to wait till things settle down before I make this big purchase. Housing typically is the largest purchase we make as a household, so to that extent, it can affect housing activity and the economy.
Do you think that the money will be redirected into tangible assets?
To some extent, for those who are leery of the equity market, certainly right now you would think, okay, well, gold is probably a good place to be, and quite frankly, I think real estate would also be another good place to be, safe haven. What are safe haven and assets? Well, government bonds. Well, look at their bond yields are now less than 1% for 10 years. So you're just if you're investing there, you're not looking for a return. You're just looking for a place to keep your money, preserve capital. Mm-hmm. That kind of thing. Yeah.
One thing I'm struck by, Helmut, is you seem actually more optimistic than I was actually expecting about the economy here. What if we were at your most pessimistic? How does COVID-19 impact the global economy in 2020-21?
Okay, in my most pessimistic, this pandemic will spread, will last through the year into 2021. The cases in China seem to have leveled out. However, it's spreading very rapidly, more rapidly outside of China, Europe, North America, and what about Africa? South America, too, where their health system is less prepared, if you will, able to handle such a thing, the outbreak. So it could become much worse. That is very true. And so we could see a global recession. That's possible. Right now the growth forecasts are being cut for the first quarter of this year, for the second quarter of this year, and again, generally expecting some sort of rebound later this year. But if this becomes far more serious, the number of cases are now 120,000. What if it becomes 500,000? What if it becomes into the millions, and deaths also rises into the 5-digit or more area? Well, you can see what's happened to air travel, to tourism, and just to avoiding again public spaces where there are a lot of people. Restaurant, I'm sure business is down. Hotels, business is down, and so it goes. And so, it would result in a recession, probably in Canada and BC as well. A global recession, it would be centered in those countries with the most cases, so it would be quite negative, and we would see interest rates cut to near zero, bond yields remain low. But of course, the employment impact would begin. We would see unemployment rise, and so the housing pickup that I envision would stall. Quite frankly, and it would be the recovery would be delayed until we get clear of this event. Mm-hmm. Yeah.
And one thing, like last time where interest rates were being cut this aggressively was 12 years ago, I guess now in 2008. There seemed like there was more bullets in the gun back then in terms of where they started interest rate wise to where they got.
True.
What type of continuing down the pessimistic road? I'm generally an optimist, but just for the sake of discussion, what kind of tools do you see available to governments in terms of combating this on the economic side.
Indeed, you make a good point. Monetary policy can only go so far, and so now there's more and more talk, and we will see fiscal response. So, and that will probably mean more spending. I probably targeted to address these issues related to COVID-19, to address labor market issues, and probably some relief for businesses. And potentially some regulatory changes as well. But it will be mainly on the fiscal spending side, taxation and or spending. The federal government will be issuing a budget within the next 4 weeks, probably. There's talk, of course, in the U.S. of implementing fiscal stimulus measures, which they're currently developing, and in some cases, the market is watching all these developments very, very closely. And when there's indications that there's a package about to be announced, the markets will go up. And when there's disappointment, markets come down, just like today. Right. And so, but we will see more fiscal response, and there is fiscal room. Quite frankly, Canada's federal debt is not exorbitant and can handle higher levels. And in the U.S., situation's a bit different. They were certainly running, more higher debt levels. But again, that's the appropriate response, and after all, government is government's role is to look after its people. Right. So if it does incur more debt, well, then you have to deal with that in the future. But for right now, I think the goal would be to address the current situation and get through it, and then deal with those higher debt levels later on. So right now, I would expect to see that in many countries. U.S., Europe, Canada, China has begun to implement measures, and so we'll see that play out as well. Yeah, but we'll still it won't cure things. It'll potentially mitigate, and it may not prevent the global economy from falling into recession should this outbreak worsen.
Right.
Yeah.
It seems to me like on the in terms of support in the health sector in Canada and our economy, we might be able to weather this storm better than a lot of other countries. What does this suggest for, do you think, the long-term outlook of our economy? Like, does the COVID-19 play into, future growth in Canada or immigration or anything related to just our spot in the global outlook?
I don't think so. I think it's even if it extends beyond this year, it will still be relatively temporary, if you will. Obviously, it's going to leave some sort of impact, and hopefully our health system in a better position afterwards, right. Better prepared, and also our population. I mean, one side benefit is personal hygiene, the awareness,
Right.
And so that
we won't have to shake each other's hands anymore.
So to the extent that becomes a habit, then we're all better off, I suppose. But I think, the Canadian economy has a lot of challenges. The transition from a commodity export-oriented to a more service-based economy, which has played out over the past 3 or 4 decades. Mm-hmm. It's nothing new and will continue. We're clearly there's so many other challenges that the economy and businesses have to face, and as well as households. Climate change. When you think long term,
right.
That is going to be clearly a growing factor determining the economic outcomes, if you will, and how we react. After all, it's our environment, right?
Mm-hmm.
And so it's unavoidable.
Well, that's kind of what I think I was getting at, in the sense of like how Canada looks in the rest of the world in an era of climate change, pandemics, political instability. Just kind of there's almost, depending on what the outcome is here. I guess that's the big.
I think favorably, quite frankly. We are in the northern hemisphere. I've seen studies that suggest, okay, climate change over the next 20, 30 years will actually result in a better agricultural outcome, if you will, that we'll be able to grow for longer and for further north. Obviously, there are other negative impacts that come along the way. So I think we're well positioned. We do have a good reputation globally, I believe, for political stability by comparison to some other countries, and the rule of law generally holds. So that's favorable. And the other big factor is demographics. Looking longer term, guys like me are going to be leaving the labor force in increasing numbers. So in response, the federal government has increased immigration levels. That'll help mitigate some of that labor force issues that are really going to be coming in the longer term. And after all, when it comes to economic growth, the labor side of things is very important. We can have need more capital investment to improve productivity. But we also need labor to execute, to use that capital. So that's another important long-run factor, which many countries are facing. China's population is declining because of the one-child policy. Right. Japan's population has been declining for years, since the 90s. So population growth is an important economic driver, and that's one factor that is at play, obviously in BC, the Lower Mainland, and other parts of the province as well, that we have this, population growth on the order of 1.5% or more in some cases, in some regions. Mm-hmm. Yeah.
And it's funny because you just mentioned, guys like you. I was going to say, so the nice part about that, not you leaving, but is that you have years of experience and you've been through a couple different cycles. You've seen a lot, right? In terms of this moment, thinking kind of specifically maybe about COVID-19, but also just the pile-on type atmosphere in which negative news is happening. Like, does this remind you of another moment that you can think of?
I suppose the great financial crisis would be one, and then in 81, 82, the severe global economic recession, when inflation was quote unquote broken, when interest rates soared, mainly driven by central banks, to 18-20%. Right. To break the back, quote unquote, of inflation that was building up in the late 60s and right throughout the 70s. So that event outshadows what's going on now, quite frankly. So in terms of ranking, I would rank when it comes to simply Canada and BC, the 82 crash. Economic recession was more severe than the great financial crisis of 2008, 2009, and the COVID-19 now I would rank below those events in terms of severity. Yeah.
I'm just curious because while we're having this conversation, I've probably had about 6 or 7 pings from Apple telling me that COVID
70% of the German population will have it by the end of the month.
Yeah, exactly. So I'm just wondering, from an economist perspective of monitoring, major global events. How has the role of media and negative media and then social media
and the speed of everything,
and the speed of it, how do you factor that in, and then also how does that influence the markets now in a way that maybe it wouldn't have even in 2008, right? I mean.
Yeah. Well, indeed, practically have instant news at our fingertips, and so it happens very quickly. So that certainly does move markets more rapidly than in the past. I go back quite a few decades, if you will, and when pre-internet days, and so you were just waiting for the radio news, TV news, and written news, if you will, to keep abreast of events. But so it really has changed, and in some ways for the better, quite frankly. The more information we have. Assuming it's good information, we can make better decisions and we can better understand what's going on. So it is positive in that sense. There's certainly some negatives to the current technology, I suppose. There's that potential for misinformation, for
so much more fake news now.
Yes, unfortunately. So there's that element, and so really, I follow the events as closely as I need to, and I really over the years have developed develop these trusted sources. So there's some sources I just simply ignore, given their sort of history, if you will. And so I have trusted sources, and I follow on a regular basis, and that's I try to just to stay on top of current events, if you will, and it's a real challenge to try to anticipate what may develop. And economic forecasters, quite frankly, are not much better than weather forecasters. So I would like to think we're a little bit better, but in some respects, but it's a real challenge when we have these type of events. But again, looking back in history, SARS was temporary. These other epidemics were temporary. The Spanish flu that broke out in 1918, 1920. I mean, that was apparently even more severe in terms of the widespread nature, the number of cases and the deaths, of course. And so that no doubt had an economic negative impact as well. Clearly, but. So I think this time around, it's going to obviously won't be as severe as that, and we'll pass.
Well, maybe we can, because I have two more questions here, but thinking of forecasting, British Columbia's economy at the end of 2020 and maybe 2 to 5 years out. Projections here where we're going to be, kind of best educated guess, and then moving on to real estate specifically.
Yeah, I think again, assuming the cases begin to diminish outside of China, and that we do have some stabilization occur, so some pickup in the second half of the year. Hopefully third quarter, but maybe perhaps it's now looking more like fourth quarter, and if not, then in 2021. So for the year as a whole, economic growth probably in BC less than 2%. Unemployment rate probably to inch up somewhat. And in 5 years' time, I would expect the economy to be at minimum 10-15% higher than it is today. So I would think our underlying growth rate in BC is somewhere in that 2.5% range. So, over 5 years, we should, somewhere be 15% higher, 10-15% higher in total economic output. The unemployment rate will very likely be lower, given the demographics, for one thing, and, of course, the ongoing growth that I see. And, yes, we may well have another recession play out. There may well be another shock event occur. The normal state of affairs is growth. In most conditions, and given our economic base and like that, our growth should occur on a regular basis. When it comes to housing, I see that with lower interest rates, with the change in the stress tests that I mentioned, that housing activity will be higher this year than last year. So I'm still looking at about a 20% increase in housing sales for 2020 relative to 2019. Housing prices on average, again, average over average year, up 10%. And again, mainly Lower Mainland, Victoria, Kelowna, not so much in the resource-based parts of the province. And in 5 years, I think housing prices could be another 25-30% higher, quite frankly. Again, assuming, I think the interest rate environment will remain low. When growth does resume, the central banks will begin to raise rates. So these emergency cuts will be unwound and undone potentially later in 21, 22, 23, we should see rates sort of normalize. And these are emergency level rates, record low rates were very likely to prevail. So, that will sort of bite into housing demand. So housing affordability, as measured by price to income ratios, price to rent rate, or rent to income ratios, price to income ratios will worsen, quite frankly. And I see that worsening in the long term as well. So given the supply constraints we have in the Lower Mainland, Victoria, and other areas relative to our demand growth, housing prices will considerably higher and will increase faster than incomes will.
Do
So in that sense, it's a negative, a negative view from an affordability point of view perspective.
Potentially the health of the city.
Certainly we need more supply, and that's going to be an ongoing challenge. More rental supply as well, and there will be over the course of the next coming decades relatively more renters than there are today because of the affordability crunch. There will simply be fewer people able to afford home ownership. And of course, units will become smaller as they have over the prior decades as well. The densification you see just out your window here will continue and be further, throughout the lower mainland markets and in other markets as well. And so, we really have to grow up, if you will, densify. There just isn't enough land to accommodate growth. Yeah, so in some sense, if you're a homeowner, you'll certainly be able to see capital appreciation. And if you're looking to enter the market, it'll be an ongoing challenge, clearly. But we do need housing. We need housing to also accommodate economic growth. And our high land prices, that's what it is. It's essentially land. It's not housing or buildings. Buildings depreciate over time. That's the land values that are problematic. And that's been the case for decades, quite frankly, and it has been a constraining factor on economic growth. There are businesses who would like to locate here, but because of high land prices, property taxes, probably some choose elsewhere. And the same with individuals who say, well, should I move to Vancouver area? Well, the cost of housing is so much higher from where I'm coming from, and so some will remain here. So remain where they are, right? So it has been a constraint on economic growth and continues to be. Yeah.
One final thought while we have you.
Yeah.
Insurance, condo insurance, strata insurance. Any thoughts on that?
Yeah, that sort of came out of the blue, didn't it? I guess I don't understand it completely, but on the surface, it appears that these major insurers are simply incurring a lot of losses, expenses, and what other way can they make it up through premium increases, right? So, and indeed, that speaks to the ongoing disruptions we're seeing to businesses and as a result of climate change. When you think about flood insurance. The effects of bad weather, and so this is only going to continue, become worse, I think, in the coming years and decades.
Right.
Yeah. So it's certainly a real problem, and there's probably a case to be made for government to step in.
Right.
I haven't thought that through yet, but there could be a case for government to step in. Instead of an ICBC, it's a condo BC insurance company, potentially.
Surprisingly, a lot of economists, even that don't typically support government intervention, are saying that. So I think that it seems like an avenue that a lot lot of people are.
It's something to be investigated. After all, housing is such a basic, an important part of our being, our existence. Shelter is a fundamental. It's food, it's shelter. And so when that is negatively impacted, I think you could make a case for government to help out.
Yeah. Well, maybe we'll leave it there. But how can people find out more about what you guys are doing at Central One Credit Union?
Okay, well, that's good. We do have a website, central1.com, and then you'll see a button at the top that says Economic Insights. You click on that, and you'll see some of our reports that are available. So we issue weekly, what we call weekly economic briefings, so the latest economic releases that StatScan puts out and real estate boards put out. We will provide some commentary on that. So it's BC focused. And some cases it's drilled down into the regions as well, and we produce our economic forecast and analyses reports on there, our housing forecast and analysis reports as well.
Yeah, we're big fans. Spend a lot of time on your site.
We watch for him, and also your colleague Brian Yu on Twitter. I'm telling you,
right? He's very active that way, and so he's a valuable member.
That's for sure.
Department.
That's
Excellent.
for sure. Well, thanks so much for your time, Helmut.
Yeah.
That was
in a time,
I feel better.
Well, yeah. I mean, in a time where people are socially distancing, we got you to the studio, which is fantastic. So we appreciate you making your way down.
You're most welcome. My pleasure.
Okay.
Hey everyone, if you're still watching, I think that means we've had another successful interview on the Vancouver Real Estate Podcast.com.
That interview flew by.
It was one of the better ones.
There were some great jokes. I'm still laughing about that one joke. And what a great guest.
It was one of the best.
We should say this is pre-recorded.
This is pre-recorded.
I've been drinking this coffee on and off for weeks.
And I'm still fasting.
Yes.
I'm feeling very good about where I'm at.
I didn't even know you were fasting. But make sure that you do subscribe somewhere around here.
Right over here.
And
I think it is right over here.
Join us for our live events. We're doing the Vancouver Real Estate Live.
There's no reasons why you shouldn't subscribe here.
Yeah, if you like Vancouver real estate.
Yeah, or real estate in general. There's a lot of useful, evergreen, non-market specific stuff going on our site.
And market specific.
And it's very market specific stuff. So if you like what you see, you can also check out our website, VancouverRealEstatePodcast.com. That's where we have the bulk of our resources. And if you've ever listened to the podcast, you've undoubtedly heard about private client services.
Matt, if you're not using PCS, you are standing still while the rest of us power walk by. You get sold prices, days on market. It's basically realtor level information at your fingertips. It's free. It's available on our website, VancouverRealEstatePodcast.com.
If you're searching for Vancouver real estate and you're not using PCS, you're doing it wrong. We also got our weekly mailer, the Live Wire.
Yes.
We got the deal of the month. We send out stats you're not going to see from the real estate board. We got it all at VancouverRealEstatePodcast.com. If you want, sign up over there. Or if you want to talk about real estate or anything really, give me a call. 778-847-2854 or Matt at VancouverRealEstatePodcast.com.
Or you can try me at 778-866-4574 or Adam at VancouverRealEstatePodcast.com.
We also got that secret line.
Info at VancouverRealEstatePodcast.com.
God, is that you?
No, it's me, Margaret.
Wow.
All right.
That was a bad joke.
All right, come on.
Have a good week, guys.
Take care.